He started with a telephone, a small satellite dish on a dorm roof, and the belief that markets reward speed and discipline. Today, his name is attached to one of the most successful hedge funds on earth, and to a market maker that moves a large share of daily trading in the United States. But the path was not what anyone expected. Kenneth C. Griffin grew up in Florida and showed an early interest in business and numbers. He read about markets. He studied how prices moved and why. He was not born into Wall Street. He built his way to it. At Harvard, he pursued economics. He also pursued live markets. In 1987, as a freshman, he began trading convertible bonds and options. He installed a satellite dish on his dorm to pull in real-time data. That single choice made one thing clear. Speed matters. Access matters. Preparation matters. According to Forbes, he was trading from his dorm room while completing his degree, building a track record before he walked across the stage. Convertible bond arbitrage was his early canvas. The strategy blends equity and credit. It rewards careful math and fast execution. It punishes sloppy thinking. Griffin leaned into the discipline of spreads and hedges. The market tested him daily. The lessons stuck. Risk must be defined. Positions must be sized. Liquidity is not guaranteed. The goal is repeatable edge, not lucky hits. An investor took notice. Frank C. Mayer of Glenwood Capital learned about the young trader's record and seeded him with capital. A small allocation validated his approach. It was not a white glove invitation. It was a challenge. Perform, or lose the capital. He performed. That led to the next decision point. Build a firm that could make the approach bigger, faster, and more resilient. In 1990, he founded Citadel. The firm started small. It did not stay small. The design was deliberate. Combine multiple strategies under one roof. Build technology that could see risk in real time. Recruit specialists who could compound small edges with ruthless consistency. Protect the downside as if survival depended on it. Because it did. According to Citadel's published history, the firm opened its doors with a multi-strategy mindset from day one, and it built risk systems as a core product, not a cost center. The playbook was simple to say and hard to run. Deploy capital across fundamental equities, global credit, commodities, macro, and quantitative strategies. Share information that reduces blind spots. Do not share conviction unless it is earned. Calculate portfolio exposure in real time. Respect limits. This was not a collection of traders under a brand. This was a machine designed to run a disciplined process across markets that never sleep. Griffin understood that an edge in markets is often an edge in plumbing. Execution quality. Latency. Pricing models. Connectivity. In 2002, the firm launched a separate business, Citadel Securities, to become a leading market maker. That decision quietly changed the empire's shape. Instead of relying on other firms for liquidity, a new arm would provide it. According to Citadel Securities, the business grew into one of the largest market makers in U.S. equities and options. It built systems to quote tight spreads, handle retail and institutional flow, and stand in the market when fear was high and liquidity was thin. Over time, it expanded into fixed income and other asset classes, bringing the same intensity to each market it entered. But that is not the full picture. building a hedge fund in the 1990s meant surviving the dot-com bubble. Citadel refused to chase stories that did not pencil out. Discipline looked old-fashioned while momentum roared. Then momentum vanished. Discipline survived. The firm's reputation for risk control grew. It hired technologists and quants before it was fashionable. It built one of the strongest research and engineering benches in the industry. It created real-time risk systems that could tell the truth in flashing numbers. That clarity is the difference between a stumble and a fall. By the mid-2000s, Citadel had become a force. The firm scaled strategies, talent, and infrastructure. The reputation was sharp and demanding. The bar to join was high, and the expectations were higher still. Compensation followed performance. Underperformance did not linger. The machine was not kind to entropy. That is how it stayed precise while growing. Then came 2008. The global financial crisis tested every assumption. Liquidity evaporated. Correlations went to 1. Funding lines were questioned across the street. Even disciplined firms took heavy fire. Citadel's flagship funds fell sharply in 2008, and the firm restricted redemptions for a period to protect the strategy. Public reporting at the time placed the decline in the flagship funds at more than 50% during the worst of the crisis. The headlines were harsh. The reality inside was harsher. Survive, or be a case study. The firm chose survival. It retooled risk. It recalibrated liquidity. It lived to fight another day. In the following years, it recovered and grew again. The lesson was etched in steel. Systems must be built for storms, not just for sunny days. Meanwhile, behind the scenes, the market-making arm grew at speed. Citadel Securities invested in low-latency systems, smart order routing, and a client service model that answered the phone and solved problems. Retail brokerages began to route significant order flow to wholesalers. Citadel Securities became the largest in that space by many measures. It also grew its institutional footprint. In January 2022, the firm sold minority stakes to Sequoia Capital and Paradigm in a deal that valued Citadel Securities at approximately $22 billion, as reported by Reuters and confirmed by the company. The vote of confidence from elite venture firms signaled something clear. Market infrastructure had become a frontier for large, durable returns. But success attracts attention, and attention brings pressure. In January 2021, during the surge in trading of GameStop and other heavily shorted stocks, questions swirled around brokerage decisions to restrict buying, around liquidity, and around the role of wholesalers. Ken Griffin testified before Congress. Citadel Securities executives stated that the firm did not instruct retail brokers to halt trading and that it continued to provide liquidity during volatile days. According to CNBC and House hearing transcripts, the firm emphasized that it fills orders and does not set brokerage risk limits. The debate over payment for order flow and market structure continues at the regulatory level. The firm presents itself as a provider of tight spreads, strong fill rates, and lower costs for end investors. Critics push for different models. The conversation remains active at the SEC, and any changes will be public and debated. The empire was not built on one engine. It was built on two engines and a philosophy. On the investment side, the philosophy is multi-strategy, risk-aware, talent-dense. On the market-making side, the philosophy is speed, reliability, and best execution. On both sides, it is relentless measurement. When a system tells the truth faster than competitors, the odds tilt in your favor. When a culture acts on that truth without delay, compounding begins. Citadel's investment engine continued to deliver. According to LCH Investments, a fund of funds that tracks hedge fund performance, Citadel generated approximately $16 billion in net gains for investors in 2022, the largest annual profit by any hedge fund ever recorded at the time. The same report noted that this performance lifted Citadel to the top of the all-time list of hedge funds ranked by net gains since inception, as of January 2023. Financial Times and Bloomberg covered the milestone and the underlying strategy shift into inflation-era positioning. The result was not an accident. The firm had prepared for a regime change. It sized positions to win when cash flows mattered again. It hedged for a world where rates rise, and where duration risk hurts the careless. At the same time, the firm made a major geographic decision. In 2022, Ken Griffin announced that Citadel and Citadel Securities would move their headquarters from Chicago to Miami. As reported by The Wall Street Journal, he cited business climate and other factors. The move was practical and symbolic. Practical, because a firm can recruit globally and base itself where it sees the best conditions for growth. Symbolic, because the center of gravity in finance is more fluid than ever. The empire would be built where the map made sense, not where tradition said it should be. Philanthropy grew alongside the businesses. According to the Harvard Gazette and other university announcements, Ken Griffin made significant gifts to education, science, medicine, and the arts, including major donations to Harvard University, the University of Chicago, and institutions in Miami, New York, and Chicago. The amounts are public because the institutions announced them, and the projects range from financial aid to cancer research to cultural preservation. Whether one agrees with every choice or not, the pattern is consistent. He directs large resources to institutions he believes compound human capital. But that is not the full picture. The core of this empire is not one big bet. It is an operating system. The operating system looks like this. Recruit the best. Give them data the moment it matters. Hold them to a standard that is both fair and unforgiving. Build tools that make smart decisions repeatable. Remove tools that no longer serve. Keep capital safe enough to play tomorrow. Then play hard enough to win today. The talent model deserves attention. Citadel recruits globally. It trains obsessively. It promotes based on performance. It terminates without delay when performance does not fit. This creates a culture many admire and some fear. It also creates outcomes. In markets, mediocrity compounds as surely as excellence. A single weak link in a risk chain can turn a tough day into a firm-ending week. The empire treats this as a design problem. If the system makes it easy to do the right thing and hard to do the wrong thing, results improve. Technology is the silent partner in this story. The firm invests in research, data engineering, and tooling at a scale few competitors can match. Market data is captured, scrubbed, and turned into signals. Risk is measured in real time and reported in formats that reduce cognitive load. Traders and portfolio managers are trained to respond to those signals without ego. When a model breaks, it is fixed. When a market changes, the model evolves. This is not a one-time build. It is a living organism. Consider what happened in 2022 from a systems view. Inflation rose. The Federal Reserve raised rates. Long-duration assets fell. Credit spreads widened. Liquidity thinned. Discretionary macro approaches with the right view and the right hedges made money. Quantitative programs with the right signals made money. Fundamental teams that discounted cash flows conservatively were rewarded. Citadel had all three. The machine was designed for this. According to LCH Investments and Bloomberg, the net result was a historic year that stood out across the industry. Here is what most people miss. Market making and asset management might appear to be different sports. In practice, they share muscles. Price discovery. Risk transfer. Liquidity provision. Technology. Speed. Measurement. A firm that trains those muscles daily in one domain can often use them in the other. The result is not simple synergy. It is a culture that defaults to precise, data-backed action. That culture compounds returns and reputation. The market-making arm entered a new phase with the Sequoia and Paradigm investment. According to Reuters and company statements in January 2022, the deal valued Citadel Securities at about $22 billion. Beyond the number, the meaning was clear. Market structure is not a utility anymore. It is a growth sector. It attracts venture capital because it is software and plumbing and network effects blended into one. The larger the flow, the better the pricing. The better the pricing, the larger the flow. That flywheel can be powerful and resilient. But with power comes scrutiny. The debates around payment for order flow, market transparency, and retail investor outcomes are real. The Securities and Exchange Commission proposed and discussed changes to market structure, competitive auctions, and disclosure. Citadel Securities responded with public comment letters and testimony. The details are technical. The stakes are simple. How should markets route and price orders to produce the best outcomes for end investors? Reasonable people disagree. Any changes made by regulators will be visible, contested, and measurable. Meanwhile, the fund kept doing the work. Hiring. Training. Tuning risk. Measuring slippage. Running pre-mortems and post-mortems. Rotating capital to where the edge was stronger. Cutting exposures where liquidity could trap the portfolio. This is the unglamorous daily effort that makes the glamorous headlines possible. The empire rests on it. The early origin of this story explains the present. A college student put antennas on a roof to get data a few seconds faster. That detail is not trivia. It is a motif. The firm he built still designs itself around getting the right data first, reading it correctly, and acting on it. It is one of the few places in finance where talk about speed, systems, and selection is not marketing language. It is architecture. It shows up in trade fills and monthly letters and annual totals. What happened next surprised those who thought 2008 would define the firm. The decades after the crisis did. Citadel rebounded, diversified further, and delivered strong results in multiple cycles. It built core businesses that can thrive when the world changes. LCH Investments noted in 2023 that Citadel's cumulative net gains for investors since inception placed it atop the all-time list as of that report. That position can change as markets and managers trade places, but the scale of the achievement is not in doubt. There is a second arc often overlooked. The firm's decision to move its headquarters was not only about one city or another. It was about optionality. Miami gave access to a growing talent base, time zone advantages, and a gateway to Latin America. It also signaled that modern financial empires can be multi-hub. New York remains the heart of markets. London remains a global pillar. But technology frees firms to place people where they can live well and perform best. This matters for recruitment and retention. It also matters for the message to young engineers and scientists who want to build in finance. You can build in more places than before. Philanthropy connects to this vision of scale and leverage. $1 bought naming rights to museums a generation ago. Today, $1 funds labs and scholarships and cultural access at a different order of magnitude. According to the Harvard Gazette in 2023, a $300 million gift to Harvard's Graduate School of Arts and Sciences advanced research and training for the next generation. According to news from the University of Chicago, earlier gifts supported economics, law, and medicine. The pattern is consistent. Invest in people and institutions that change the slope of human capital. That is the same logic used in trading, applied to society. So what can builders learn from this empire? First, build an edge in something that compounds. For Citadel, it was risk systems and talent density. For Citadel Securities, it was market-making infrastructure. In any business, an edge that gets stronger with scale is the best edge. Second, respect the downside. Many firms fail when they mistake a lucky streak for a process. The market does not care about streaks. It cares about liquidity and math. Third, run toward complexity with tools, not bravado. Technology is not optional. It is the only way to compete at the front of any modern market. Fourth, speak with results. In finance, reputation is a trailing indicator of what the numbers say. Let the numbers speak. What about the hard parts? Every empire has them. 2008 was a near-death experience. The 2021 retail trading surge put the firm into the center of a political and regulatory storm. Moving headquarters created critics and fans. These events test mission and culture. They force clarity. The empire's response was consistent. Keep operating. Keep explaining. Keep measuring. Let time and data tell the larger story. Critics ask a fair question. Does concentration of market-making power create risk? The answer belongs to regulators and to the market itself. The healthy response from any firm at scale is to welcome competition, publish relevant metrics, and step up when liquidity is scarce. According to public disclosures and client testimonials, Citadel Securities emphasizes fill quality and price improvement. Others will present their numbers. The market is a scoreboard. Think again about that first satellite dish. It was a small piece of hardware with a big implication. The person who needed those quotes faster was betting his future on being prepared. That is still the posture. The empire built around that impulse is designed to prepare. Every day. Every trade. Every risk report. That is not a slogan. It is a habit. From a dorm room in Cambridge to a global network of trading floors and servers, this is a story of building with precision. From $1 million of seed capital to the top tier of all-time hedge fund gains, this is a story of compounding. From a small market-making desk to one of the largest wholesalers in America, this is a story of scale. According to Forbes, Ken Griffin remains one of the wealthiest Americans, and according to LCH Investments, is investors have captured historic gains. The data points will change. The method likely will not. Here are the transferable lessons in plain language. Build systems that work when you are tired. Hire people who love the work enough to keep tuning those systems. Move fast without breaking your risk budget. Diversify edges, not just assets. When the weather turns, respect it. There is no shame in carrying an umbrella. There is shame in pretending the rain is not there. When opportunity returns, deploy decisively. Markets reward boldness most when others are frozen. Put a structure behind your boldness so it does not become recklessness. Can this approach work outside of finance? Yes. Replace trades with features. Replace risk limits with budgets. Replace positions with customers. The mechanics are similar. See reality faster. Decide faster. Execute cleaner. Measure more honestly. Repeat. The firm that lives by these rules will outcompete rivals who live by vibes and slogans. The close of this story is not a period. It is a comma. Markets will change again. New platforms will emerge. New rules will be written. New managers will take their shot. The empire described here will have to adapt again. That is the game. The people who built it built themselves for that game. The early signals are clear. The machine is still listening. The culture is still learning. The capital is still ready. From a satellite dish to a skyscraper. From a small seed to record gains. From a single strategy to a two-engine platform that shapes how money moves. That is how Ken Griffin built a modern financial empire. By trusting data over drama. By recruiting talent over celebrity. By favoring systems over slogans. The result is not a coincidence. It is compounding. If you enjoyed learning about this empire builder's journey and you're interested in building your own empire, there is something you need to know. This person and 78% of the Forbes 400 use a specific strategy to build massive businesses and multiply their wealth systematically. But here is what most people miss: there is a pattern. A strategy hiding in plain sight. The Forbes 400 know it. They exploit it. They have built fortunes with it. And it has been hidden from mainstream business education for decades. First link in the description reveals what the titans of industry do not talk about publicly. Watch it next. 10 minutes that could change everything.